The Nigerian equities market is coming back from a negative start this month as buying interest in high-value stocks is driving a recovery. Meanwhile, traders say they expect the bearish sentiment to persist this week. Gbolahan Ologunro, Research Analyst at Cordros Securities, joins me for this discussion. Gbolahan, thank you so much. It's a pleasure to have you on the show today.
Thank you for having me.
Well, it's a brand new trading month, and we still see the investors' favorites. But talk to us about what is that strategy to have this month? I know that investors are keeping their eye on the economy, not much to see there. I know they're also keeping a keener eye on the political happenings. We have two major contenders. Yeah. We have, of course, we have the candidate from the first one of the major parties. We're waiting for another one tomorrow. And I know investors are trying to interpret all of that. But what is a good investing strategy, taking all of that into consideration?
Yeah, so thank you for having me. It's good to be in your studio. So, I mean, for the equities market in the month of June, we think there are two major factors that would shape investor sentiment. And firstly, we are looking at development in the fixed income markets, particularly with reference to direction of yields. If you recall, at the last NPC meeting, the central bank decided to hike interest rates by 1.5% to 13.5%, and on that day, we saw markets recording a loss of about 1.8%, which is the biggest single-day loss that we've recorded since December last year. Aside that, we also think that uncertainties pertaining to the 2023 elections will also weigh on the investor sentiment this year, just given that uncertainties regarding to who would eventually secure power. So you tend to see that increased aversion for risk assets as investors decide to sort of move their funds into risk-free assets in order to hedge against election risk.
Now, following that MPC meeting, what all the analysts I spoke to said, look, with this hike, definitely yields at the fixed income market are going to be more attractive. We're going to see that exodus, etc. We did see an uptick, especially in the one-year treasury, but there seems to be some kind of a pullback, and we've not seen that, dramatic shift to that market.
Yeah, so I mean, in the fixed income market, you have seen, in the fixed income market, we saw the stop rates for the long-dated instruments increasing by about 1.7% to 6.9%. And I think that's one of the rare occasions where we've seen DMO allowing yields to trend upwards in line with the policy posture of the central bank. But I mean, so far, so good in the fixed income market. We have not seen sort of surge in yields, so that has also been somewhat positive for the equities market as positive sentiment as gradually starts to, filter back into the market. If you look at market performance yesterday and today, after we saw a loss of about 2.2% in the prior week. So we think, if we don't see sort of sharp uptick in yields in the fixed income market, that would sort of provide some comfort to investors in the equities market.
Okay, so in all of that comfort, where are investors bargain hunting? Are they trying to take shelter in safe haven stocks, if there are, at this time, but where are they buying? Yeah,
so we think investors are still focused on those growth stocks with good history of dividend payment. If you look at stocks like MTN, Dangote Cement, these are stocks that you regard as growth stocks given the attractive potentials in the industries that they operate, in addition to, the fact that they are also market players, and that has enabled these companies to deliver very strong earnings over the last 4 or 5 years. So we believe that investors will still continue to take a good look at these companies despite, expectations regarding uptick in yields and the uncertainties in the broad economy.
What about the banks? What with, of course, the CRL, the debits, and, all that's good. How lucrative are the banks right now? So
for this year so far, we think banking stocks have been somewhat static. We've not seen so much of movement in their share prices. If you look at year-to-date returns, currently at about 25%, but we don't think banking stocks have really benefited from the broad rally in the market. And that is, that can be attributed to a number of factors, some of which you have highlighted. You look at the regulatory actions from the CBN, CRL debit. The environment is still not, that's positive in terms of banks creating risk assets by growing their loan book. So these are the headwinds confronting the banking sector, and that's why investors have been somewhat, just trying to ensure that they don't overexpose themselves to, the banking sector, just given those issues highlighted. But notwithstanding, we still believe that, getting to the tail end of the year, the dividend yields on those banking stocks would be quite compelling for investors to reprice their shares upward. If you look at Zenith and GTCO, dividend yields at about 13%. We think that is compelling when you compare it to the yield on one-year treasury bill currently at about 5%. So we still see scope for investors to re-rate banking stocks despite, challenges in the broad sector.
Oh, well, that is a fair argument. Now, every week on my show, I talk about inflation, talk about, of course, the shrinking consumer wallet, the cost of living crisis. Not just Nigeria, it's global, but more economies are feeling it more than others. Of course, here in sub-Saharan Africa. So for the companies, I know that we've talked a lot about the sachet economy. Companies having to adapt to the pockets, especially of the critical mass. How is that impacting on the bottom line of these companies, and how do we project that vis-a-vis their earnings going forward this year?
Yes, so for us, we think companies in the consumer goods space are those companies that are highly exposed to the broad macro challenges confronting the economy, and we think what these companies have done as a way of responding to the challenges in the economy is sachetization, like you mentioned. So just producing products in smaller sizes that can be easily afforded by the average Nigerian consumer. So that has sort of provided some support in growing volumes, which would be positive for expansion in revenue. However, across the sector, industry players are still grappling with, compression in margins, and that's just given the high uptick in the high price of, commodities, given, the tensions between Russia and Ukraine that has driven commodity prices upwards significantly. You also take into account the devaluation of the naira, so that has also amplified, the naira cost of importing raw materials. The operating environment,
energy.
There's also the energy. Exactly. So it's a combination of all of these cost pressures that has led to compression in margins. But for industry players, what they have done is to, fashion out innovative ways of responding to these challenges, one of which is sachetization, in addition to also, providing incentives for consumers to embark on bulk purchases. So we think, price increments has also played another significant role.
Some have been successful.
Yeah, some have been successful.
Interestingly.
Yeah, with, price increments just to preserve compression in margin.